Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. Welcome to August, the 4th of August to be exact. Market call 11 a.m. on the East Coast. Dan, Nathan, Guy, Adami, joining you here live on a market that is recouped about 70% of the losses incurred on Friday. That old song, What a Difference a Day Makes, we'll see. I don't know exactly what this is. Bounce off maybe a very short-term oversold condition, but maybe more so that the weekend you didn't see maybe the fireworks that maybe market participants anticipated in the back end of Friday's trading action. Hello, Dan.
Yeah, again, that seemed really odd. I mean, I think a lot of folks, if you looked at what happened on Friday and you look at all the news that people were digesting, and if you look at basically, if you're thinking about it through the lens of the markets, a lot of the earnings reactions were not particularly great. You got to go back to the banks, and I think there was some enthusiasm about that. But I think, Netflix, I think, put a lot of tech investors on their back heels. Their response to their results, the stock didn't see an uptick. It felt like for a week, and then we just saw a lot of disappointments all over the place. And I don't mean exactly earnings disappointments or guidance disappointments, but market reaction disappointments, right? Because again, expectations were really high. And I think that just punctuating, this earnings season was that Meta and the Microsoft, and having such sharp gains in two of the largest, market cap companies, and really two of the most important companies as it relates to this whole trade. That kind of got people, I want to say, off sides a little bit, Guy. And then you have the jobs report on Friday, the reversal on Thursday in the market, the jobs report on Friday, the firing of the BLS, a whole host of other things. I just don't know. And again, you might be listening to me and looking at me if you're watching this right now or listening to this right now. You'd be like, how are you so dumb, Dan? Of course you're going to buy that dip. You know what I mean? Every dip gets bought. I just feel like, we were down 3% off that reversal on Thursday. It just feels like, down 5%, run of the mill sort of little thing could have been good. But right now we're just right back to it, Guy.
Yeah. And today's like today, it will further empower and add to the complacency that the market has been right to enjoy for quite some time. April notwithstanding, those few days in April. But even with that, I mean, the recovery obviously has been historic. I think people feel empowered. They see something like Friday, and the first word that comes to their mind is, well, this is just an opportunity for me to buy some of the things that I've been waiting on. And, each passing time that happens, I think people get more and more sort of emboldened. And I think by definition, get more and more complacent and lazy. And I don't know, though, why that pattern should be broken, because it's worked for people for so long. But I'll say this. What we heard on Friday in terms of the BLS firing, and again, it's not politics. I want to be crystal clear, but it speaks to, what are we really looking at here? And the point that I've been making to people, and maybe somebody needed to go in terms of the number of revisions we're seeing, and maybe the numbers are flawed, or maybe more importantly, the systems in place are flawed, and maybe somebody had to take the fall for that. But the question I would ask is, if the revisions were to the upside, in other words, instead of seeing 250,000 jobs lost, we saw 250,000 jobs found, would we be having the same conversation? Because if you think about it, it's problematic either way, whether it's the upside or the downside. So I just throw that out there, and I think that was something the market was chewing on Friday.
Yeah, listen, again, it just seems like it was a distant nightmare, I guess, that April period or whatever. And, it did feel like things were going haywire. And as bad as it felt, in early into mid-April, it feels that good, or that you just used the term complacent, And so I just thought like a move back towards that breakout level, from May would have been, or late June or early June, would have made some sense. We have a late addition to the program here.
I didn't mention him because I thought, but we are joined. You just go ahead, tease it out.
Well, there he is, Carter Braxton Worth. I mean,
I was in we've all been, it's about like the DMV or the post. I was at a Verizon store replacing one of my children's broken phones, and you give up your spot after an hour and a half, back the line, do it again. So anyway,
well, we hope we didn't rush you here.
Happy Monday.
Happy Monday, man. Well, listen,
Monday.
You had on this program and your Worth charting work, and then on Fast Money, I think, and tell me if I'm mischaracterizing this. You were just saying the way in which we had kind of been rallying over, let's call it the last month or so, was not the sort of thing that was inspiring too much, like, I don't know, too much enthusiasm to the upside, meaning like, in my mind, it was becoming like a 1 up, 2 down sort of scenario as far as the broader market or so. But like, there was a little bit of this idea of breadth, but at the end of the day, it really was the largest names dragging things up. Just give us a sense of where you are in the S&P, and obviously we can isolate the last few trading days, but like, how are you into earnings season? How are you thinking about things? And did I mischaracterize a little bit of how you were thinking about the breakout?
Well, no, I think it's important to characterize the market just for what it is, right? Always as best as possible, and then to try to profit accordingly. But the facts, which removes everyone's opinions, is that we had an aggressive sell-off, right? A precipitous and sharp decline, whether it's news related or not. In this case, I think there was something deep seek or deep fake or something about tech, and then it became a tariff thing. And at the lows, of course, on April 9th, the S&P is down 21+%, and the NASDAQ 100 is down more. Think about that. The index, having lost 20% of the entire value it's ever created since inception, 1928, all in a matter of 4 or 5 weeks. It shows that, one, these are risk assets, or an aggregation of risk assets, and it's not for the faint of heart, as demonstrated not only by the aggressive nature of the sell-off, but the equally aggressive ricochet, a recovery to the point where the sell-off began, and then some, making slight new highs. But the equal weight S&P has not returned and exceeded its February high. The Dow Jones Industrial has not. Even the Magnificent Seven only briefly getting back above and now sort of sitting at that level. But I think the thing that can be said, valuation aside, is that it's a fairly mature move over several months, drawing in a lot of money, a lot of short covering, and a lot of rethinking on the part of strategists on Wall Street who are paid to try to, divine the future for the general market. Many reducing their price targets into the swoon, obviously reacting to it, not predicting it, and then increasing their price targets into the ricochet, reacting to the ricochet, not anticipating it. But here we are, and we have a 1 day drop, right? And so here we are, and this is as of course, Friday. It doesn't include today's action, which is recouping all of, or close to all of, Friday's drop. But what we know is that if you were to try to determine where support comes into play, we can see, and it's just the basis at the beginning of support. It's usually the level of a prior peak before a sell-off, and then you check back to it. But support, importantly, right, is not a plywood board or even more firm, a concrete floor. It's a mattress top. You get down to support, and then you can sink further into support. If you see the next chart, support is a range. It really goes all the way down to sort of the 575 level. And you'll see on the next chart just as a midpoint. And so the question is, today's ricochet or recovery notwithstanding, if and as this is the beginning of something more meaningful, right? Not just a 2-day sell-off of 3%. Support starts, right? Comes into play at the upper band and sinks on. You can sink into support. Were you to get down much more than that, then you have no support. And so I think those are good things to have in the back of one's mind or on the corkboard in front of you at your home or office. And these are levels that matter. Now, today we're almost filling Friday's gap. My hunch is to take advantage of some of the reprieve that one might be seeing in individual stocks and to reduce exposure.
All right, so we made an all-time high last week in the S&P 500. Thursday was the day I want to sort of focus on. So if we can go back to our charts real quick, and you could see what appears to be on Thursday at least, and maybe we can isolate a bit of an engulfing pattern. Now, today, you look at today's action and be like, well, guy, but with all that said, you have the beginnings of a potential reversal in action. My question to you is, what do we need to see on the downside for validation? Now we'll go back to your charts. Is it a sinking into the support? Like, when do you start to get confident that that might have been something?
Right. So if you were to just look at all the sort of minor 3-4 day dips since the low, so take the April 9th low, which is clearly that plunge low, from which the ricochet began, and then these little givebacks of 2-3 days, 4 or 5 days, all along the way. Each of those is typically, and you'll see it here, 3 or 4%. So this one is right in line, although it's quicker. Most of those were 3 and 4 days. This one's only 2. Just the question that has to be asked, right, is this we can pull up things like the Russell 2000, the Dow Jones Transportation Average. You can do a lot of aggregates, and they don't look at all like the market, right? And so the question is this just another minor, and that means just a day or two, just a percent or two dip, give back, and then off to yet new highs? Or is it ironic where it occurred? It recurred right on a week where there was maximum news, and now there's no more news, right? There isn't an Apple earnings or an Amazon earnings or a Google earnings or a Meta earnings. That's out of the way. There isn't a FOMC meeting. There isn't a payroll coming up. There isn't a GDP report. There isn't a tariff news. I mean, the tariff news is back and forth all the time, but the point is there's no catalyst to go higher day to day. One could say, well, there's no catalyst to go lower either. True. And yet the strange thing is catalysts, the downside, come out of nowhere, right? Mm-hmm. Whereas just a surprise, the upside. Or said differently, from the 30,000 foot view, there's only 2 ways the market or an aggregate such as this can go higher, right? It's either through earnings growth or multiple expansion or some combination of the two. And the earnings growth is sort of blah. And in principle, what would be the reason for expanding the P multiple? Unless one says, well, they're going to cut rates eventually. Rates are a non-story. They've been here for 3 years. That's the truth, right? And so it can't be always looking for rates to do this. Rates will go to 6-7% and it'll crash the market. Rates will go to lower and the Fed will cut and the market will soar. It's just not a reality. Rates are where they are. It's a Goldilocks moment. It's a Goldilocks
moment. It's interesting, Carter, and to your point about multiple expansion and and so we've been kind of tracking some data. 60% of the gains this year are literally just multiple expansion in the S&P 500, right? And then if you think about I think Rosie put this in his note this morning, 60% of the earnings growth is coming from the top 10 names. And you can say, well, that's always the situation or whatever, you know what I mean? But when I think about that concentration and I think about the theme in which the market has been, kind of moving higher in and around generative AI and CapEx and the like, and some of the kind of, I want to say the disparity we saw with some of the results and some of the stock market reactions, that's why I think it's important to look at that equal weight at this point, because there's definitely been some dispersion within the Mag 7 or the top 10 or so. Let's go to the RSP for a second here, because you mentioned, support is not, like a
fixed level. It's not, there's no magic one level. Sure.
Right. Look at, if they were to draw a line, and to use your expression, from that prior high late last year, it's literally to the penny. I mean,
we can do interesting to be a good thing to do too. While we're doing this, we'll do the DIA, which is the Dow Jones. You'll see the exact same thing. Maybe just do them back and forth because they're completely different indices. One is 500 equal weight, and this is price weighted for 30 stocks, and it's the same damn line. If you draw that line along the top from the prior high, I mean, you're talking about to the penny, and this is the remarkable thing about.
Well, let me ask you this. All right. So on that dispersion front, I just want to rip through. You just said, well, Apple doesn't have. All right. Let's look at Apple for a second here. Okay. So Apple initially, after the report, I think it was up a few percent or something like that, gave it all back. You know what I mean? Gave it all back. And look at it. It looked like nothing happened here. I mean, literally the earnings event was a non-event, right? If you look at that, but it's a downward sloping 150-day. This is one of the worst looking charts, in my opinion, in the S&P 100. I just want to be really clear about that. And it is fascinating that this was, the largest market cap company in the world 9 months ago, and now it is literally 3 trillion to Nvidia's 4 trillion. Okay, which is fascinating. Microsoft's 4 trillion. All right, then let's look at Amazon. Okay, so this reported, and it had that huge gap on Friday. It continues to the downside. You could make the argument that was almost that double top. Look at the gap.
It's the same concept. It doesn't have to go right to the former high.
Right. And so, when you think about this, let's pull up Tesla for a second. So you could say, well, I'm cherry picking, right? You know what I mean? I'm picking the 3 that have not performed particularly well. But again, there's 3 of these 7 that act like dog shit. and then there's the Microsoft and the Meta and that sort of thing. So, and NVIDIA, which we haven't seen the results yet, one way or another. Like, are we likely to see more like separation in some of these names? And does the Mag 7 go away? Is the Fab 5, the Fantastic Four? I mean, I know you hate those sorts of things, but my point is, the more that you lose one by one is you lose pillars of the bull case in the broader market, in my opinion.
Right. So to sort of summarize all that, let's look at the Mag 7 and remembering the lines we drew on the RSP and the DIA. We pull up the Mag 7 and do that same exercise, which is to look at current levels in relation to the former high. You will see the exact same line. A horizontal line, we made a slight new high. We are not above Mag 7, the highs of late December. And so it's all the same circumstance. I mean, Apple's a curious one, right? Because is it defensive? I mean, one could say, no, it's highly risky. It's the one-trick pony. It's a phone. It's a device. And yet, of course, by virtue of that cash and by virtue of some other things, they are defensive. And at some point, and you'll notice during certain swoons, Apple has exhibited some relative outperformance. So I'm not sure Apple's a short here. Yes, but it's not acting in line with others, to be sure.
A couple of weeks ago, you had a great call on the dollar. You thought we were setting up for a bounce, and that proved to be correct to the day, by the way. I think you really bottom ticked it in terms of the low in the dollar. The dollar then subsequently rallied. But I bring this up because it appears as though we're starting to reverse course again. I ask you, was that it for it? Because it sort of comes on the heels of a comment from Wavy McFly, if you want to throw that up, about gold mining stocks being on fire, which, they're bouncing again. And that's part and parcel to what's going on in the dollar. So was that the move you expected in the dollar, or did you think there was a little more gas in the tank?
Yeah, hard to know. I mean, it was the idea of that particular call was that it was just so many days, weeks, months without any meaningful bounce, far below the 150-day moving average and due for some sort of bounce. So we've had one, and now much harder. Stick with it, abandon it, take the small profit and run. In principle, this was getting very lopsided, right? And that's what we're looking for when everyone's on one side of the boat, right? Trying to catch the other side as the boat flips. And we see these momentum trades or anti-momentum all the time. My hunch is to stay long the dollar here for a bit more. But what we do know is that rates are, again, stuck where they are, and I think going lower, and the dollar a little less clear. We've had a bounce, and so closer to a pair of twos, maybe to your question. And the one, the one area that after resting now for 4 months is due to come to life again in principle is gold bullion. Miners are a different story, right? They are not really tethered to gold on a 3 and 6 month basis. They are just a consistent. All year long, gold miners have been the single best performing area of the market equity complex, and there's no change to that.
All right, Carter, I'm going to switch gears for a second here. Palo Alto, PANW. That's how it comes out, Guy Adami. So this is a really interesting name. So let me just set up some stuff that you don't really care about, right? So, when you think about the narrative around generative AI, a lot of folks have been saying, okay, so we had the hyperscalers, we had the chip stocks, we had the servers, right? So now how do we think about this in like the application layer, right? What are some of the initial industries that are going to benefit most from this trend? One of them has clearly been cybersecurity, right? And so that's just been a theme. And so look at this chart. So this has been a bit of a darling. Let's go to a 5-year for a second, and then we'll go back to this one, right? And so the gap that we saw here last week was that they're making a bid, and let's go back now to the 1 year really quickly. So the day that it was making new all-time highs, possibly threatening a sort of breakout of this kind of consolidation that we've been in for a while, news comes out that they might be, about to bid $20 billion for a company called CyberArk, right? And then you see the gap lower is what they did. And then you see it continue to go lower. You see that flat 150-day moving average. You see the fact that it got rejected at the same spot over the last year. You see the fact that it's been a massive underperformer relative to the NASDAQ, right, over the last year in the S&P. What do you do with a chart like this? Let's say you didn't know why the stock gapped or anything like that. What do you, because this is one that we get questions about, don't we, Guy, a lot about like folks looking to play this space, and this is like kind of tops of the list. But from a technical momentum standpoint, it seems like this thing has really stalled out over the last year.
Yeah, for sure. I mean, you have poor relative performance for quite some time, and then you have news related, I guess. I wasn't quite following but I mean, you say pretend. I don't have to pretend. I actually don't know what's going on, even though you just explained it. It's the if we just were looking at lines on a page, you would just say, well, and pretend it's an athlete or a student. Well, what happened there 3 days ago? Yeah, she always gets A's, but she came in, she got a D on that paper. What? How could that be? She never gets D's. Or he always scores the leading. He had no point. What? And then you find out why. Well, he was drunk the night before. She's doing. It's just about behavior. Something has changed as of 3-4 days ago. The drop in gap, and what was precursor to that is the poor relative performance. Right, not able to get above its February highs, where the S&P is well above, and so sell, at least reduce longs. And for those who are short sellers, it's a candidate.
And you look at that, I mean, you talk about engulfing pattern, you can see that one day it sticks out like a sore thumb. And, you say technicals don't matter. Well, you can see clear as day it mattered then. I'm going to throw you another curveball and go to UPS because it's a question we have from E&P. And if Jacob or Stephen can go back to 2005. So you got to go way back. And I bring that up because prior resistance becomes support. I mean, you can draw a horizontal line, go up a little bit, go back to where you were, that longer term chart, and you draw that horizontal line across from those prior highs and then these lows, and you can see we're right up against it. Yeah, there you go. We're right up against it in terms of where support should be. So prior highs, prior resistance, the bottom we saw in 2020. I mean, theoretically, this should be if we're going to stop, this is the place to stop.
Yeah, bad stuff. I mean, think about again, and this would be a case where, she got a D again. Yeah, but Lane always gets D. Did it again. Yeah, he had 3 fumbles. Yep, every time. I mean, it's just there's something wrong with it. Now, at some point, the word cheap comes in, or all of those things. But in principle, stay away.
Yeah, Guy, it is pretty fascinating. Like I just drew that line on my fact set. I mean, it is to the penny when you look at that move from 05 to that low at COVID and where it is right now. But I love Carter's response as well. I don't know. I mean, like bad action's bad action, right?
Yeah.
And so the idea is, we say this all the time on Fast Money in our pods. Like, there's thousands of stocks out there. Go have a ball, find one that looks well, acts well. Maybe there's a good narrative around it, because this is one of those ones where I don't even think you're ready to say it's so bad it's good. You probably
and not when you're just recently off a fresh drop in gap. It's just incredible that and again, the real incredible thing is not the weakness, not the preceding strength. It's that the notion, and it's promulgated on Wall Street, that value can be determined at the valuation. How does one explain? This is not some software company that maybe has clients or doesn't or makes profits or biotech. They haul packages. You can figure out how many packages, you can figure out how cost of gasoline, the planes, the employees, you can figure it all out. And yet you can go from 85 to 250 back to 85.
Yeah.
All right, Carter, very last one, I promise. Let's pull up Berkshire A. So you've been following the market. You probably looked at a gazillion charts over the last 3 decades or so. This is one that has always had a very special place in many investors' hearts, right? When you think about it. And so let's look at the 1 year right there. So today the move is because, and Guy, I don't know, man. I can't remember. Like the headline was that Berkshire takes a nearly $4 billion impairment charge on their Heinz, whatever, you know what I mean? Investment or something like that. That's kind of a big move, right? And so to the downside. And then let's look at a 5-year for a second, because you can draw a near perfect uptrend, right? You can see it's
right down to the penny.
Right. So what do you see here? We know that there's going to be a change in the guard. Is this like the potential for some really interesting shift in investor psychology around this name? Is the technicals, are they telling you anything into that?
So it's not acting well as the chart, but this is not idiosyncratic. So we just do a standard 2-year chart. Let's maybe wait for that. And then let's go around the horn and look at key insurance stocks, which is, after all, what this is. Look at AJG. That's the AJ Gallagher. And we'll go around the horn, and you'll see the same exact same pattern. Look at Progressive, PGR. This is a major insurer. Right? Let's look at Aflac, the duck, the quack quack AFL. Let's see the same pattern, right? So the current weakness in this, one more Chubb if you'd like, and these are all well-known names. Sorry, CB. So the point is here that it's the same thing. They're all under pressure. So it's not the railroad part. It's not the candy thing. It's out of the Coke thing, or all that stuff. It has something to do with what's going on, and whether this is rates related or about the excess premium they've earned, and now rates of return won't be as high as they've been. But the weakness, and that's important to say. So coming to a judgment at Berkshire is coming to a judgment about the whole group. Now there's an ETF that captures all these, KIE. Maybe we'll look at that last night. That'll also have things like AIG in it and MetLife and Pru. But if you pull that back, it's all very slumpish. Now, does it get a whole lot worse from here? I don't suspect so. My hunch is to be contrarian and buy the weakness in Berkshire. There it is.
Yeah. What I've said, and I'm not suggesting I'm right, but I think the fact that they have now probably $350 billion of cash in a $1 trillion company, and as the market goes up, Friday notwithstanding, up days are going to be bad days for Berkshire Hathaway, because I think what the market is saying, in addition to Carter's parallel of the insurance companies, is by definition, if they have that much cash on the sidelines, they're not participating in an equity rally. And if they're not participating, we're not going to reward them. So somewhat counterintuitively, but I do believe this to be the case. If we were to see a prolonged sell-off in the equity market, I think Berkshire Hathaway, Dan, would outperform to the upside.
All right. Well, listen, we had a lot of curveballs for Carter. He came in here hot right from the Verizon store with one of his children. I'm sure you're kind of hot about that. Guy and I don't know about you guys, but I have bought many a phone to replace a broken phone from a kid. Verizon, AT&T, they love us as customers. But a lot of what Carter just did there was on the fly. They were curveballs. Other than the S&P, that's what you came in with. So we really appreciate it. And, last thing I'll just say is I started talking about Berkshire. I had freaking Buffett on my head. Guy had like $325 billion in cash on his head. And he just put together a little bit of a mosaic there that explained a lot of it. So that's really helpful. Nothing slick, guy. Just charts. Just charts. That's worth charting. That's Carter Worth. Thanks for being here, man.
All right. Enjoy. Thanks, guys. Bye.
He's the man. I mean, one-off charts are one-off charts, right? But that guy, he looks at thousands a week and he makes certain judgments there about that. Should we take some questions?
I looked at some questions, but before we do, a couple of weeks ago, that's actually longer than that, we went out to Jersey City and we did something for our friends at Moneyline that we're actually sort of excited about.
Yeah, so this was really cool. Aside from being our sponsor and partner, we are doing some bespoke content with them on some of the things that they're really leaning into with their client base. And the one that came out late last week, check it out. We had a lot of fun with this, and we are going through some of the costs associated with higher education. And we had a young gentleman who, really smart guy, a hustler. And when I say hustler, I don't mean like a hustler like a guy like hustling guy in the street.
Paul Newman in Color of Money.
But what I'm saying, this guy is hustling. Not only is he kicking ass in school, but he's working a lot to pay for those bills. And we had a great time. Maybe those guys can pull it up here a little bit. It's on our socials, but go check out Planet Money. I think they have it ready to go here. At least something to show what we did. I think they have it.
You're stalling.
They might. Don't we do this in TV when they're saying stretch a little bit? Stretch. Okay, I guess they don't have it.
Okay.
What's a trailer? You could have shown a screenshot, Jacob, or something. I mean, just
we got Gary, and we'll put it in the show notes, as they say. Gary Webb's asking about Palantir, which reports, I believe, after the close today.
Correct.
Is that right? So again, what he's saying, and I don't know if he's saying this makes sense as being sarcastic or not, but let's just say it's sarcasm for a second. So it's 25%. Let's call it 26% EPS revenue growth, which is significant, which is great. Of course, the problem is, you're talking about a company now that's approaching, I want to say, $380 billion in market cap. So you better hope that growth continues to justify this valuation, Dan.
Yeah, I mean, 42% expected EPS growth decelerates to 26% next year. Revenue growth of 36% expected this year decelerates to 29. I mean, I think expectations when you have a stock trading at 96 times sales and trading at the market cap that it is, you're expecting big upside. Like you're expecting that 36%, year over year revenue growth is going to be north of 40. You're expecting that earnings growth to be closer to 50. And this is a company that, by the way, does not, I mean, their GAAP net income right now expected to be $838 million this year on revenue of expected to be 4 billion or something like that. I mean, listen, this is one I can't, I think I've called this like the dumbest stock I've ever seen. And I really do believe that. If the revenue was growing 36% on a 10 billion sort of revenue base, fine, but it's just not. And it's coming off a very low sort of base. And the fact that the expectations are supposed to decelerate next year rather than accelerate off of that low revenue base, it's not particularly interesting to me. Last quarter, guy, good number. There was nothing really to shake a stick at. The stock was down 12%. I mean, I think there's a big downdraft coming at some point. But listen, look at what Meta did last week. You know what I mean? Like beat and raise, that stock was up 11% at one point, and that's not a small market cap company.
There's a company we used to talk about almost on a nightly basis years ago that we stopped talking about, but maybe we should start talking about again. And the CEO's been in place, I want to say, since 2007-ish when Fast Money started. Wendell Weeks. The name of the company is Glassworks, and we have a question about the chart. And if you look, I mean, this out of nowhere has become everybody's darling again. And, the chart is lower left, upper right. It's been basically unabated now for the last few months. We'll take a closer look at this, but if you look at it in the context of history, and I don't even know if that's important at this point, but you go back and look when this stock made an all-time high, Dan. I think it was in somewhere around 99, 2000. Is that right? 99, 2000?
Well, by the way, this Corning is a fascinating story. And I mean this sincerely. I grew up in Syracuse, New York, and upstate New York, and Corning is not far from Syracuse. So the GLW, it was Glass Works. Okay, that's what that stands for. So they used to make glass. They used to make ceramic stuff for, in the kitchen and all that sort of stuff. And at one point they moved towards, making industrial glass for like cell phones and stuff. And if you look at their, top customers, it's Samsung, it's Apple, it's the cell phone guys, LG, Volkswagen, that sort of thing. So the fact that this company has come back the way it has, if you want to go back to all-time highs, and there was also a fiber optics component of this guy, if you remember, back in the late 90s and into the early 2000s. I mean, this was the poster child for a bubble stock. And I think I've told this story before, but things were good back there in 2000. And I remember my wife, me, and a handful of other people we worked with, we were down in the south of France, and this is the summer of 2000, and we were sitting at one of those outdoor cafes, and we hear some American voices behind us. We start chatting them up. And this is these two couples who were, I think one couple were a set of teachers. The other worked at GLW at Glassworks in Corning, New York. And these guys are having this trip, and they're talking about the game. I don't mean to laugh, and I know that sounds.
But you're laughing.
No, it was just so emblematic of the times that these people, made a lot of money on paper being long this local, stock. And most companies or most people who live in some sleepy town in the upstate where, it could be Illinois, New York, Michigan, whatever the hell it is, they're not benefiting from some publicly traded, the 100-year-old industrial company that now is like, the toast of the town as it relates to whatever, the internet build out and that sort of thing. So it's just really interesting from a sentiment standpoint. And you can just see, if you isolate that move from the late 90s to 2000 and then what happened into the early aughts, I mean, it was devastation. So the fact that it was. And let's hope that didn't add to a lot of pain that people felt in that period too.
Before we get out of here, Enphase, which is like battery storage. If you look, this was a name that I think captured the imagination of a lot of people couple years ago, but not so much anymore. I mean, they've basically, if you look at it, the decimal point has been moved to the left in this stock, and that's not me being a wise guy. I mean, that's effectively what's happened. question is, at what point does this get interesting? I think is embedded in the comment about end phase. And we've almost round tripped the move from 2020, and I think if in fact we were to do that, there's probably still a little bit of room on the downside, maybe to 25 or so.
Yeah, I have no take there. But just to kind of wrap things up here a little bit, Guy, I think you and I are both a little bit surprised that Thursday reversal into the data on Friday, a day that felt really kind of sloppy into the close. You and I have been in the camp that a little fear put back in the market would be a pretty decent thing. We had a VIX that was above 20. We had a dollar that was selling off after that bounce. We just talked about that with Carter. We had yields in the 10-year selling off, which in my mind was selling off for the wrong reasons, right? And if that was kind of a run ahead of basically a dovish Fed or that sort of thing, I'm not sure that that's the sort of thing that is so positive for equities. If you're lowering interest rates or becoming more dovish because the labor market is weakening fairly dramatically. And I'll just end it here, is that the stock market still at these levels, despite being 2% from those all-time highs, with the S&P at 6,300, is discounting none of this, in my opinion.
No, I think it's all fair. I'm glad that Carter was able to get away from the Verizon store to join us. A little bit of a surprise this week, but I guess it won't be a surprise once we announce it again. But Elizabeth Young-Thomas will be joining us for Market Call on Thursday. In a few minutes, I'm speaking with Peter Bookvar. That'll drop tomorrow. You have some conversations as well coming up this week.
Yeah, I have Brett Winton of ARK Invest. He is their main futurist, and we're going to talk about a whole host of things, robo-taxis. I think ARK in general, Kathy Wood has said they see this as like a $10 trillion TAM. And obviously Tesla, in their view, is well positioned for that. They also think robotics is a huge part of this. And so, at the end of the day, I think there's going to be a lot of like longtime bulls in Tesla who are going to basically just reorient what this company is in their own minds, right? It's going to be X and XAI. If that comes into the fold, it's going to be robotics. It's going to be robo-taxi. And to be honest with you, that makes some sense, Guy. Like if you believe in this company and you believe in the founder, and if you believe in his ability, or the CEO, to kind of transform industries, which he has, for all intents and purposes, rolling up all these companies and having a new view, and really Tesla, and I know this sounds dumb, maybe Tesla turns into like a Berkshire Hathaway guy, and maybe Elon Musk becomes the Warren Buffett of this new age of, you know what I mean? Like Carter just told us, you got the candies, you got the insurance companies, you got, all that other stuff in Berkshire. Maybe Tesla is like the Berkshire of the next 50 years. I don't know, but like, they're going to have to kind of tell a different story. And I think guys like Brett Winton are going to be the ones to help parse through that. I'm not telling you that he's right and this and that, whatever. And I don't have a strong view one way or another. I do about Tesla. I do about their current business. I do about EVs, but they're going to have to convince me about what the robotaxi and what Optimus means and all that sort of stuff.
I love when he comes on Fast Money, so that'll be a deep dive. I'm looking forward to that, but we appreciate your time, and we'll be back tomorrow at 11 a.m. for Market Call, Dan.
All right, brother. Thanks.